Hey, it's Jason here, and I want to talk to you in this video about a very important topic. It's the idea of the capital stack and how to organize a capital stack to buy a business. Now, first things first, you may be asking yourself, what is a capital stack? As I would define it in a pragmatic sense, a capital stack is basically the way you organize the capital, aka the money, in order to buy a business. Generally, there are going to be multiple sources from which you are going to be pulling from as you buy a business. And one sec, let me close the door here so we have a better environment here. Okay, so the capital stack is basically the combination of debt and potentially equity that you're going to be using to buy a company or a piece of property. But I'm really speaking mainly about business acquisition, specifically in the United States of America in this video. So what is a capital stack and what does a capital stack consist of? Well, again, the capital stack is just the sources of money that are ultimately pooled together to buy a cash flowing business or property. Now, what are the types of sources of capital that make up a capital stack? Well, in the most general sense, it's debt and it's equity. Equity is basically ownership that may also have a payout component, and generally does have a payout component from a dividend. That's the most general way from which equity positions are paid out. It's through a dividend. When a company cuts a dividend, all the equity holders receive a pro rata distribution. A pro rata distribution means a distribution based on the percentage of equity ownership the different owners have. Okay, so that's equity. Debt is a loan in the most simple sense. It's a loan. Now, naturally, you can fundraise both debt and equity sources from a number of different generators, if you will. There are a bunch of different debt and equity forms. There's a lot of different types of investors. There's a lot of different types of lenders. So let's talk about firstly some of the forms of lenders, some of the debt instruments that are out there in the marketplace. First of all, there is SBA debt finance. The SBA 7A is a program that operates on a 10-year fully amortizing term here in the United States. The SBA 504 is another debt instrument. The SBA 504 operates on a 25-year term. There is commercial debt. This is traditional debt that you can use to buy either a property or a business. If it's a business, usually it's going to be on a 7-year term. Sometimes it'll be a 3-year balloon, but amortized over 7 years. That's for a business acquisition. Commercial debt for a property may be on a 15 or a 20-year amortization schedule, maybe on a 3 or a 5 or a 7-year term. That basically means when is the balloon payment, right? So there's this idea of a balloon payment. And there's also the idea of the total amortization schedule. And by the way, I made a video discussing different finance terms, different financing terms. It's really important you watch that video if these terms I'm saying to you now are not making sense. If they aren't making sense, you need to watch that video. It's defined, I believe the video title is Key Financing Terms to Know. If you search my name and then Key Financing Terms to Know, you'll see that video and you can get a better understanding of some of these important working definitions. One of the other big forms of debt is seller finance. You can get a first position seller finance note. You can also get a second position seller finance note. Now, what's first versus second position? And I know we're talking about a lot of different items here, but these are the core items that make up debt. These are the core things to be thinking about for debt. Well, first versus second position ultimately comes down to who gets to collateralize the loan first if the deal fails, right? So if the person who took out the loan or the business that took out the loan is unable to make their payments, who gets first access at the collateral in the event of a foreclosure and a bankruptcy? The first position lender gets the first access to the collateral. The second position lien holder gets the second right to the collateral. Usually in most deals in the event of a foreclosure, the second position lien holder is not going to get any proceeds in the event of a bankruptcy, whereas the first position lien holder will. And that's just because of the fact that most deals are not fully collateralized. Unless, of course, if you contribute a lot of equity to the deal in the form of cash. which is the back end of the deal, right? So the front end of the deal is the first position loan, then maybe there's a second position loan, and then perhaps there's equity in the form of cash. That's often how a business acquisition or even a property purchase will take place. A first position loan that may go 75% of the purchase price, then maybe a second position seller finance note, for example, that makes up 15% of the purchase price, and then perhaps that final remaining percentage, which in this case, 75 plus 15 would remain for 10% of the remaining purchase price to be paid through cash, which perhaps you raise from an investor, an equity investor. That equity investor, you could then give a one-to-one equity arbitrage, basically meaning, hey, Mr. Investor, you put in 10% of the purchase price in cash, I'm gonna give you 10% of the deal. And then I'll take the risk of guaranteeing the first position loan, and I'll operate the thing, and I'll secure the second position seller finance note, and you as the equity investor simply put in 10% of the purchase price, and I'm gonna give you 10% of the deal in exchange. So that's an example of how a deal could take place. Now, I've talked on this channel a lot about the 95-5 deal structure. This idea that through an SBA 7A loan, you can basically get 90% of the purchase price from a first position SBA 7A loan. That would be on a 10-year fully amortizing term at around a 6% interest rate right now. So say for a $1 million purchase price, you could get $900,000 approximately from a first position SBA note. You can then go to the seller and say, hey, I will pay you 5% of the purchase price after I pay off the entirety of my first position SBA note, by saying to the seller that you're gonna have to wait for the totality of the first position note to get paid off before you get your second position seller finance note. By structuring the second position seller finance note in the way I just described before, you actually get that seller's second note to count as equity in the deal. This is about working the legislation for the SBA to get that seller's second note to count as equity in your deal, because you're not making payments on the seller's second note until you completely pay off the first position note, which means the lender is comfortable with that arrangement because, again, you're putting all your debt focus on the first position note. And then that final 5% of the purchase price you can put in cash from an investor. You give an investor a 1-to-1 arbitrage or a 2-to-1 arbitrage. I've talked about equity arbitrages and raising equity in another video. I believe that video is titled How to Raise Private Equity. Search my name plus How to Raise Private Equity and you'll see that video. And that right there is a wonderful way to get a deal done. That's the 95-5 deal structure. And it works great, it works fantastic. But ultimately, you can get a bank note for the first position note. You can get a seller finance note for the first position note, though generally speaking, seller finance notes are tougher to procure for business acquisitions than they are for real estate purchases. You can get a private lender to give you a first position loan. There are private lenders out there. Sometimes it could be an individual. Sometimes it could be a boutique lender, almost a small pseudo bank. It's not actually a bank, but it's a group that pools their money together and makes loans, first or second position loans. Of course, there are second position debt instruments in the marketplace as well. A seller finance second position note is very common. We've already talked about that here in this video. Private lenders in some cases will offer second position debt notes. Naturally, a second position debt instrument is going to have a higher interest rate, all things created equal, than a first position note. When I say note, that basically means a debt instrument. Debt instrument means you're repaying the loan plus interest, but you're not including an equity position in any loan. Any loan is just promise of repayment plus interest. It doesn't include equity, right? But for a seller's second note or a second position debt note of any kind, generally you're paying a higher interest rate than you ever would for a first position bank loan or a first position loan. And why is that? And the answer goes back to what we talked about prior as it relates to collateral and to the risk of a foreclosure. A seller second note or a second position note that comes from a private lender has more risk. It has more risk because if the note fails, the first position note fails, if basically the person receiving the debt is unable to make payments on their loan or loans, then it's that first position lender that gets first access to the collateral to the repayment of the loan. Whereas that second position debt instrument has to wait until the first position lender gets all of the proceeds that they're owed. And in many cases, by the time the first position lender takes all the proceeds possible in the event of a foreclosure to recoup the note, to recoup the loan, there's no more assets left for the second position lender to sell or to take possession of. So when you're structuring a deal, usually the first position loan will have a lower interest rate than a second position loan. Often you can get a longer amortization schedule on a first position loan than on a second position loan as well, though there are exceptions to that rule. Now, one of the things I really recommend you do when you're structuring deals is try to get the seller to include some form of seller finance, either in the first position or the second position. Generally, it'll be easier to get a seller to provide second position debt than it will be for the seller to provide first position debt, because usually a seller wants to take a bulk of cash in at closing as a form of security and certainty. Not always, but generally speaking, it'll be easier for you to get a second position seller note once you're going to give the seller, say, 70 or 60 or 80 or 90% of the purchase price up front at the closing table. If you're going to give the seller 60 or 70 or 80 or 90% of the purchase price at closing, it's a lot more easy to get the seller to agree to a second position seller finance note. Right? So what you can again do is go to the bank and get 60 or 70 or 80 or 90% of the purchase price from that first position loan. You then structure a seller finance second position loan for 5 or 10 or 15 or 20% of the purchase price, and then you go raise a small amount of capital from an investor to make up the difference. Now for real estate, it's a bit different. It's a lot easier to get a seller finance first position loan in real estate than it is in business. Why? The answer is real estate is a hard asset. There's collateral there. The foundation, the roof, the building, the dwelling, the unit, or the units themselves have fundamental value, which means there's collateral behind the loan. And when there's collateral behind the loan, it's less risky for the lender. A business without a lot of assets will make a seller more uncomfortable when it relates to first position seller finance, generally. Sellers will say, well, I don't know how you're going to operate the business, and I want to take in a lot of cash up front to reduce the risk for me as the seller. But there are exceptions to this rule, of course. That said, for real estate sales, because there is indeed all that collateral, and because of the tax benefits associated with seller finance, it's actually quite possible to get a first position seller finance note. And that's how I got started in M&A. My first deal was a 7-figure real estate deal wherein the seller provided me slightly over $1 million in first position seller finance. The seller provided me about 88% of the purchase price in a seller finance note. I went out to the marketplace, raised the remaining 12% in cash, raised that from a private investor, actually raised a little bit more than 12% because I needed a bit of working capital as well. But I raised another 15%, raised ultimately about $200,000, received over $1 million in seller finance first position note, in a seller finance note, first position, raised a bit of capital, and that's how I got the deal done. That worked very well for real estate, but it's something that's a lot harder to do when a deal lacks all that collateral. Traditional businesses, generally speaking, don't have as much collateral. So when you're financing a first position business acquisition, you're usually looking for a lender that sees itself as a cash flow lender that will lend against the earnings or the cash flow of a business. When you're buying hard assets, generally you're looking for an asset-based lender or a lender that views the assets, the collateral, as the key variable that provides the lender the security and the safety and the willingness to lend. The willingness to lend. The reason I always talk about the SBA for those of you in the United States is because the government guarantees an SBA loan. So you can get high leverage finance to buy businesses that may not have a bunch of collateral, but the lender will still make the loan anyways because the government basically acts as the collateralizing agent. The lender can loan 90% of the purchase price for a business that may not have a lot of collateral because the government will come in and clean up the mess if the deal goes bad because of the SBA guarantee, which at the time of filming this is 90%, which is very high. It means 90% of that SBA loan is guaranteed by the government. So if your deal only has a little bit of collateral, that collateral makes up the final percentage of the purchase price, right? So you have a deal, say it's $1 million deal, and approximately $900,000 of the purchase price can get guaranteed by the government for a first position SBA note. And then if your deal has $150,000 in trucks and inventory, then your deal's basically fully collateralized. The first $900,000 was collateralized by the SBA loan, roughly speaking, through the SBA guarantee. The remaining 10 or 15% of the deal is collateralized by, say, the inventory and the trucks and the equipment. And now you have a deal that's basically fully collateralized, even though there isn't a lot of collateral in the deal itself. So that to me is why I always talk about the SBA for somebody trying to get their first or second deal done. Though if you're getting into real estate, I would recommend looking for a high leverage first position seller finance note, which is how I got started. So hopefully that explains the capital stack. Again, the capital stack is really the combination of debt and equity that makes up the purchase price of a business acquisition or a property purchase. For those of you who don't have a lot of money and who want to keep the majority of the equity in your deals, you're really going to be looking for high leverage, AKA high debt deals where the majority of the purchase price is financed. And then you go raise a little bit of private capital from an investor or three. And that, by keeping most of the deal on the dead end of the capital stack, you really are allowing yourself to keep a large percentage of the equity of the deal without you using your own money, which is ultimately what I talk about and what I teach and what I'm doing in real life here in 2021. It's what I did in 2020. It's what I started doing in 2019. Well, I really started the process in 2018, but I got my first deal done in 2019. So I've been doing this. I'm practicing what I preach. And if you're interested in this premise and you've yet to do so, be sure to subscribe to the YouTube channel. Share your comments below. What do you want me to talk about next? I'm happy to share more insight with you, things I've learned from being in the trenches. If you've liked the video, thumbs it up. And with that, I'll talk to you in the next video.